Hey everybody, welcome back to the channel. Now today's video is in response to a post I saw on Instagram where I was communicating with an individual, and the individual was asking, why do I have to pay interest on my own money when I borrow it from my life insurance policy? So obviously the person don't understand how it works and understand the details of it. So I want to take this opportunity to explain it because I've heard it from other people as well who don't understand how it works. So I want to make this video for all of you who really don't understand how the borrowing works in a cash value life insurance policy. And at the end of this video, what I want to do is make sure you have a clear understanding of how it works and also understand how it's beneficial to you, because a lot of people don't understand that. So that's my whole goal for this particular video here. And what I've done is I've actually jotted down some points that I want to explain because I don't want to miss anything important to discuss. Okay, so let's start. So he's asking, why do I have to pay interest on my own money? All that time I have my money growing and it's supposed to be my money, but I got to pay interest when I borrow my own money. So the first thing I want to explain is that it's actually not your own money you're borrowing, okay? You're actually borrowing the life insurance company's money, all right? You're using your money as leverage. So it's like a secured loan, right? So you have, for example, you have $50,000 of cash value built up and you borrow $40,000, okay? You can borrow up to the amount that you have in there in cash value. So you borrow $40,000. You are borrowing the insurance company's money, okay? This is how your money can stay and continue to grow interest, because I'm sure you've heard that before, that, hey, I borrow my money and my money stays in there and still grow interest. Well, how's that possible if it's your money? That cannot be possible if it's your money. There's no way you can borrow your own money or withdraw, however you want to look at it. If you had 50,000 in the bank and you took 40,000 out, you now have 10,000. So the only way you're able to have your still whole 50,000 in there continue to grow is because you're not actually taking your 50,000 out. You're borrowing against it. So when you borrow, that 40,000 is coming from the insurance company, right? So that's why you have to pay interest on it, because you're not taking your money. Your money continues to grow there uninterruptedly, and you're using your money as leverage so that the insurance company will lend you money now, and and you don't have to apply for a loan. As long as you have the cash value in there, you can borrow up to that amount. You don't have to apply for a loan. There's no credit checks involved. So it's an ultimate leverage that you have here. All right, so that's the first thing. Now, you do have an option to withdraw your money. So I want to explain that to you. You actually can take your own money out, but that wouldn't be borrowing, that would be withdrawing. So you would be withdrawing your own money if you wanted to. So if you had $50,000 in cash value, you can withdraw $40,000. You can. But my question is, why would you want to do that? Because you're doing two things when you withdraw your money. Now you have less money in there. So now instead of having 50,000 in there, you have 40,000. Why wouldn't you want your money to continue to grow instead of depleting it? Right? Doesn't make sense, right? So the second thing is that you can only withdraw up to the amount of premiums that you paid into the policy without suffering a tax consequence. So therefore, any interest that's earned when you withdraw, you will pay taxes on the interest. So from that $50,000, if you paid $35,000 in premium out of that 50,000, then you can withdraw, I should say, up to 35,000 without facing any tax consequences. But if you go over that, you would pay taxes, because you're going to pay taxes on the interest. So you're withdrawing your money and depleting your money, making it lower, and then you can't withdraw over the amount you pay in premium, or else you're going to pay taxes. The whole goal is not to pay taxes, right? So with a loan, however, when you get a loan, you do not pay taxes on a loan, okay? So that's why you want to do it in a loan form instead of a withdrawal form, so you can A, don't deplete your cash value, and B, don't pay any taxes, okay? Now, you might be saying, hey, well, I'm going to be paying interest on it, and that's still going to make me pay more money. So what's the point? So here's the thing. If you work with the right insurance companies, you will never pay more in interest than you are credited in interest. Because remember, your money is still there earning interest and being credited. So when you work with the right companies, you will never pay more in interest than you are being credited in interest. So, for example, let's say the interest rate on money you borrowed was 6% and your credited amount was 5%. Those companies would adjust the amount that you're borrowing against and credit that with the same interest. So if you borrowed $35,000, then $35,000 of your cash value will be credited the same 6% in interest that you're paying back for the loan. Hopefully that makes sense. So they'll make adjustment to make sure that you are not penalized for borrowing against your money, right? So you will not be charged more in interest than you are being credited, okay? So they won't do that. So it's either you're going to have a zero wash loan, which I just explained, 6%, 6%, 5%, 5%, or you can have an arbitrage, meaning you are actually credited more than what you're paying in interest. So you could be credited 9%, depending on what type of policy you have, or 10%, or whatever that percentage may be, but you're paying 5 or 6% for your loan, right? So there's no point where you would ever be credited less than what you're paying in loans. It's either going to be the same or you're going to gain more in interest, all right? So far, it makes no sense to do anything else than the loan, all right? What's next? So when you and just to make this clear as well, in terms of working with the right companies, the first part of getting that right is to work with the right agent or broker. So if you have the right agent or broker, you don't have to worry about the right companies. They will make sure that you're with the right company. They'll take care of that for you. All right, so the next, keeping your cash value in there. Why is that beneficial? Because you're going to have more compounding, right? You're going to have more compounding. So instead of withdrawing my cash value and making it less, why don't I just let it stay and keep compounding? Because when I have it keep compounding, I'm going to have more to leverage. So now I have 50,000 to leverage. If it keep compounding, I'm going to have 55,000 to leverage, 60,000, 70,000, 80,000, 100,000. It keeps growing, and now each time I go back to rinse and repeat and borrow against it to go make some more money or whatever, now it's more. You have it sit there and let it grow. It's going to compound more. Also, your cash value is what you use for retirement income as well. So if you're going to have it keep compounding and growing, you're also going to have a lot more for retirement income. Why would you want to pull it out and withdraw it when it could be compounded and keep going and growing, so you have a lot more to leverage in the future and you have a lot more for retirement? You want to borrow against it. So now you have your money working in two places. Makes sense so far? Hopefully that makes sense. So this is why it's the smart way to borrow against your policy and not withdraw it, right? So you want to do that. Next thing is, the other point this person made is that I had zero cash value in the first 2 years of my policy, and I'm supposed to be, I'm paying all this money and I have zero cash value in the first year, and it takes a while to build up, and I have to pay interest on my own money. But the reason why you only have $0 in your cash value for the first 2 years is because you don't have the right policy. Everybody always talk as if this is the only way it could be done, and they don't understand that it has to be structured. If you're trying to borrow against your policy and you're using that as a strategy to build up cash value as quickly as possible and maximum cash value, then it has to be structured that way. They're thinking this policy, this regular policy that's built mostly for death benefit, is all policies, and they're not listening and educating themselves that there's a difference. It can be structured where instead of having zero cash value, you can have 80% of what you pay in premium in cash value the first year, just like that. Imagine from 0 to 80. That's because it's structured for high cash value and minimum death benefit. So you don't have the right policy, sir. That's why you have zero cash value in the first couple of years. You don't have a policy that's structured for maximum cash value so you can borrow against it for infinite banking, the concept of infinite banking. Not every policy is designed for infinite banking. Not every any permanent policy is designed for it. It has to be structured and designed that way for maximum cash value, so you have early access to that cash value. So you just don't understand that you don't have the right policy. So you should have gotten with a person who actually know what they're doing and know how to structure that policy so it has maximum cash value up front. So that's the thing. You have to get with a person who knows how to do that. That regular policy that's designed for death benefit, don't speak out and say that this is how it is when you don't understand that that's how your policy is designed. You don't have a policy that's designed this way. So don't compare the two or confuse the two. You have to have it structured correctly. I want to hammer that point across. What's next? I'm going to leave you with this. All right. So I've explained those things to you. I've explained that, hey, it makes more sense to borrow against your policy and not withdraw it. And you're not borrowing your own money, you're borrowing the life insurance company's money. That's why you have to pay interest, and that you would never be credited less than what interest you're paying. So you're not losing at all. You never lose. You're going to either get the same, you're going to get or get more in interest credited. Plus, you have to have the policy designed correctly so it can work for you in this way. All right. And again, I've explained that it makes more sense to keep your cash value growing so that you have more to leverage in the future and a lot more to use for retirement income instead of withdrawing and depleting it. Now, here's the question I want to ask you. Why does it make sense to use the insurance company's money? Why does it make sense to borrow against it? Right? You're saying it's my cash. Why can't I just use my cash? Why would you want to use your cash? All right. So here's the question I would ask. Let's say you have $30,000 in cash, right? And you need to purchase a car. Would you use your $30,000 in cash to purchase that car so you can buy the cash so you're paying no interest? Or would you rather get the car, get a loan, pay the bank 4% in interest, and then use that $30,000 that you have and invest it or put it somewhere where you can have a possibility of getting 10%? What would you prefer to do? So the lost opportunity cost is the reason why this would make sense, because if I can get a loan at a cheaper percentage and use that money that I would have used to buy cash and make a lot more percentage on that, I'm winning, right? I'm adding. So that's why. So would you rather, that's why I would do it, but would you, I'm hoping you're seeing the sense behind this here. Would you do that? Would you rather pay the car for 30,000 cash and have no interest, or would you rather borrow a loan, get a loan, and pay 4% interest, and then use that 30,000 to make a higher percentage, double-digit gains? What makes more sense to you? All right, comment below. Let me know. All right, so hopefully that makes sense to you guys. Hopefully I explained it well. If you do have a question, if there's something you're still not clear about, you can ask the question and let me know. Now, I explained this and more in a book that I recently wrote, I released in June, called Get Your Life Together. It explains how life insurance works and how you can actually use it as a tool to build generational wealth. So when you are working with an agent, you're coming from a place of an educated consumer, so now you can tell them what you are looking for instead of being sold something. All right, so hopefully that will be helpful. Now, if you haven't subscribed to the channel, make sure you do so. Hit the notification bell so that you're notified whenever I drop a video, and please like, so I know that you like the content or find the content valuable. It doesn't cost you anything to like, so like and share with someone that could benefit from it as well. Hopefully that was helpful. I'll talk to you soon.